I had a remarkable conversation with a colleague a couple of weeks ago. As a friend in LA, my friend Larry, he runs an e-commerce company. He's a neat guy. He's in his 50s. He's got this like big, crazy COVID work from home beard that he's sporting now. And I ran into him and he goes, Mike, I'm so worried about inflation that I bought a $2.5 million house this year. I was like, that's surprising. He said, look, I've got a 3% mortgage and inflation is going to be running way higher than that for the foreseeable future. And I want to inflate away my debt. I want to pay back today's loan in tomorrow's dollars, is what he said. He told me that, he said, for my whole life, I've been conservative with debt. Like I would keep 1-to-1 cash to debt. But it just seems so clear to me now that we have this new generation of inflation coming and keeping cash is going to be dangerously expensive. So I relate this story for a few reasons, but really because it highlights a lot of the themes of 2021 and the risks that we face for the housing market in 2022. Larry locked in his mortgage for 30 years. If rates climb to 4%, would he do the same transaction? His payments would be way higher. That deal may not be doable for anybody else. But maybe Larry got his like right at the right time. But if rates climb that quickly and now it's not doable for other people, does that mean the top of the market grinds to a halt and Larry is suddenly upside down and he can't sell? On the other hand, like as Larry points out, it sure feels like inflation is here for at least a while. And so if I've been saving for a down payment, does that mean I need to put that cash to work before it erodes away? Does that actually encourage me to take transactions faster because I'm worried about inflation? So I don't have answers to any of these grand questions about where rates will go or inflation. Frankly, I don't think what Larry does either. He has strong convictions and he's trading on that position. And I'm kind of envious of that. But frankly, we're still in unprecedented times. And, so what we do at Altos is we're going to cover today, and what we do for a living is to read the real-time signals. So what we can see right now in the real estate market and what the leading indicators are telling us already about 2022. And then as the conditions change, we are going to keep measuring those and keep reporting on those and keep making the best decisions we can. So we'll all use this to best inform our clients, most of whom are not as certain as Larry. And an uncertainty in the real estate market may be increasing now. Like the volatility, the variables that we're facing are still unprecedented as we emerge from the pandemic. And because that uncertainty is there, the thing that home buyers and sellers need most is the data. So every week, Altos tracks every home for sale in the country, all the pricing and all the changes in pricing and the supply and demand metrics. And we present it here for you to be able to take it to your clients because frankly, they need it now more than ever. And in the next few years, we'll see if Larry's investment real estate decision was wise or whether it was foretelling of maybe a different time. So let's dive in to things we're going to tackle today. We're looking at where the market stands right now. We can already see things, leading indicators for 2022. We can start to measure what's happening with the end of forbearance, the forbearance process, and any risks associated with that. The other risks that that are pretty clear for 2022 is what happens if and when mortgage rates rise. How sensitive are consumers? And the other factor in there is second homes. So One of the things driving the boom of the last couple of years has been, as rates have been super low, people have been buying second homes either for investment properties or vacation properties, or keeping their first property when they buy their next one that they're going to move into. And so unprecedented volumes of second home buying. Is that the trigger that causes a market to change from this major boom time to a correction? And then, of course, what we try to do through the conversation is how we talk to home buyers and sellers about the data right now. All right, let's look at some data, shall we? So the median home price in the US for single family homes right now is $385,000. That is, it's about 10 to 12% higher than last year. And it looks like we'll finish the year about 10 to 12% higher than last year. The headlines you'll still see are sometimes showing 17, 18. Those are ticking down every month. The headlines that you typically see are backward looking. They're on sales that happened before. For example, the Case-Shiller index that they just announced was the August number. And that is for transactions that happened in June, July, and August. So it's still showing very, very high on the year-over-year comparisons. Those will start to, in the first quarter, when those traditional numbers start reporting at the full year, those will be moderating down. And you'll notice they're starting to tick down from like 18 to 17 to 15%. And so the way we're looking at it now is you can really see in the data, it's going to be about 10 to 12% for the year. A massive 10 to 12% is a massive price increase year over year. It's not down. It's just off that record from earlier in the year. On our chart here, the light colored line is the price of the newly listed cohort. So these are the homes that get listed for sale each week, the new ones that come to market. And this one is always valuable to pay attention to because it's a leading indicator. The ones that get listed for sale are by the sellers and the listing agents. They're taking into account all the latest data about, did I see a lot of bidders on the last house? Are there a lot of people at the open home? And what this number is showing us is that normally you can see most of these scales each year. You can see each year's cycle here. And most of the time they peak way back in June and start ticking down for the rest of the year. That's because the strongest inventory gets listed in the second quarter. And then as the summer gets later, then you price a little bit of a discount so that it doesn't stick around till like after school starts. This year, because transactions still happening super fast and still plenty of demand, the new listings price stayed elevated way out further in the year. And so that's evidence. There's still lots of buyers out there. It tells us that we're already set up for a very strong first quarter of next year. Most of the annual price gains are going to happen in the first and second quarter, and we're already set up with strong demand in there. And you can see it in this leading indicator, the price of the new listings, the fact that it stayed higher. Last year, it stayed higher well into November, even stronger than this year. Last year was, the crazy nuts. So not quite as crazy nuts, but still plenty of strength in these leading indicator. On the inventory side, we are currently at 400,000, just over 400,000 single family homes active, unsold on the market. What's fascinating about this is inventory is actually declining faster than I expected even a few weeks ago, last month. Expected a slower decline as the market cooled into as it normally cools into the autumn, the fall months. But what's fascinating is that we have each year, in November, December, a few homes get listed, fewer homes get bought, but inventory declines to reset, usually in January, sometimes middle of February, before it starts climbing. This year, inventory didn't hit its bottom until April 30th. People kept buying and buying and buying. And so our whole year was out of whack. Normally by April 30th, we're well into new inventory. So we peaked this year in September at 437,000, and we're now down 10% lower than that. And because each week has been slightly fewer than expected, we're actually revising our year-end forecast on how many homes are for sale there. A couple of things that you can see with this inventory chart. The 2018 line, I've got it highlighted here. It says 2018 inventory didn't yet decline by this time of year. In 2018, we had rising rates. Rates rose from like 3.9 to 4.9% from April to December. After December, rates started falling again. And what happened was the market cooled enough that a little bit of inventory built during 2018. And you can see 2019 was the only year that started with more inventory than the year before. So if you or your clients are saying what's going to happen with it, if and when rates rise this year, you can show that there is indeed likely some sensitivity, like we will indeed have build a little bit of inventory if rates rise. And you can show it because that's the last time rates rose was that 2018 window. And so you can see exactly how much it did. It didn't cause a spike. It doesn't cause a big crash, but it does cause a little bit more inventory. So that's something to keep an eye out for and to help your clients know that if rates rise, that'll mean a few more. But it also means that those sellers are going to be more and buyers are going to be more, but as rates are rising, so it's a little bit more expensive for buyers. So it's a double-edged sword. So you might have a little bit more selection, but slightly higher cost. Here's another way to look at the inventory curve. And I want to share this with you because this is how we project how many we will start next year with. Each line on this curve, on this chart here, is a year. And you can see the normal curve. Inventory usually peaks in July, starts fading through the end of the year. It hits its little bottom, maybe February 1st, January 1st to February 1st, and then starts climbing again. 2020 was the crazy year. And we just gobbled up inventory all year long. So we started 2021 at just over 400,000 single-family homes on the market. We started the year with more than we have now. And as it looks like we're going to end the year, at this point, it looks like we're going to end under 300,000. And so this is what this projection, the dotted line here, is what we've been revising down the last few weeks as there are fewer and fewer homes on the market. This is happening faster than I expected, which says to me that demand has stayed higher later in the season than it normally does. So it's a stronger slope down. And so if we start the year at, say, 290,000, then if we're lucky, we're on our back to our normal curve where we start getting greater inventory in February, then it'll start climbing up and it'll be a little more normal curve next year. But it doesn't really give us any room to get back to that normal level. Like there's no sign in the market that's going to take us from 300,000 to that 800 or 900 or a million where we start the year with normally. So if rates rise, we can see some climb, maybe 10%, but not 300% more. We're a long way from normal. So keep that in mind as you're thinking about new inventory coming to market and how the changes might hit. And of course, the biggest place where inventory might come from is the forbearance market, the mortgage forbearance market, the program. During the pandemic, as many as 6.5, 7 million homes were in the mortgage forbearance process where they opted to have the option to not pay their mortgage if they were impacted negatively by the pandemic. That program is ending. And we are taking out tens or hundreds of thousands of those each week, and they are resolving. They're getting either into new loans, or they're starting paying their old loans, or they're selling the home and paying off the loan entirely. The most important thing to note about the forbearance process, so this is data from the mortgage bankers. The bottom line here, the little brown line, is Those are the Fannie and Freddie loans, the GSE loans, and those the majority of the market. And less than 1% of all loans are in forbearance. Of the Fannie and Freddie loans are still in forbearance. Less than 1%. It's a few hundreds of thousands, and those are resolving very quickly. And what we see is as we've gone from 7 million to under 1 million in the program, we know that almost none of that inventory has come to market, but maybe the last people who are hanging on to their forbearance are in the worst shape, and maybe they will be forced to sell. That's the number we're looking for. And so I actually, let me see if I can, I'm curious if we do a quick poll here. So now we're at the end of the forbearance process. And I'm interested if you, as a real estate professional, have spoken with any homeowners that are still in the forbearance and trying to figure out their resolution. This is very telling because we want to look for anybody who maybe, like if they're thinking of selling, we would know about it. We ran this same poll a few months ago. I think it was August, maybe September. And at the time there was about, I think, 10 or 12% or some amount like that, low teens, that had, of our group, that had talked to people who are in forbearance. So I'll let a few more folks vote right now. And so I'm interested in seeing where you are. And is that greater now or is it lower now? Okay, give one more sec to answer the question. Do you know anybody who's in forbearance, and what are they planning on doing? Are they planning on selling? Are they planning on not selling? Okay. Okay, let's look at our results here. All right. We had 141 answers. 5 of us have talked to homeowners in the forbearance process who are planning their exit. 4% of the people who just answered that poll. That's way lower than it was a few months ago. And it's a really fascinating thing. Like it tells us that there's really very few that are likely to come to market there. I saw Redfin announce something where they had measured at the low end of the market around the country. They think that there may be some of those properties that are, and low end, they were talking about like $150,000 or $180,000 and under, that were coming to market, getting listed because of their exiting forbearance. We haven't really been able to find that in the data, but we're going to keep looking, and I will check, and we'll do a little bit of local check when we look later in the local data at the end of the session. So as of right now, almost no signals of any of the forbearance loans coming to market, certainly not in any distressed way. They're not short sales because nobody's short, everybody has equity. They're not in foreclosure because they're not upside down and they can still sell very quickly. So if they're getting sold, they're people who are selling and taking the equity that they have in the house. Maybe a few tens of thousands that'll happen over the next 6 months. It doesn't move the needle on inventory. While we're talking about mortgages and the potential foreclosure, delinquency rate, the main theme that I want us to keep in mind for 2022 is that we will likely during the year hit record few homes in anywhere in delinquency, including anybody who is still in forbearance or just finally working out forbearance. We still have, a few 100,000 there. And including those, we're at 4.2 or 4% of all mortgages in some kind of delinquent state. And the record low was just under 4%. And that was when we started 2020, that first quarter, because we had years of rising equity and rising prices and dropping rates. Fewer and fewer and fewer people go into the delinquency pipeline. It's just such a good time to hold on to your mortgage. So we're likely to hit that again in the next year. So one of the big things is that any buyers who are still holding out for some kind of crash or some kind of like opportunity to swoop in as a vulture, I guess my question to them is like, how long are you going to hold out? It looks like even if market turns dramatically from things like rising rates or big recession or something like that that might kick in, the people who own now are in really good shape. They have record equity, they have record low rates, they have lowest payments, they have lowest debt payments overall, the American consumer. Like, it is very unlikely that we're going to see any surge in delinquencies or foreclosures next year. We do want to pay attention to where rates are. I like to point out that I've bought 3 homes in my life. First bought my first home in 1996, and it was like an 8.25% interest rate. And I was afraid rates were going to rise, so I locked in for 30 years. I bought my second home in 2001 at a 6.5% interest rate, and I was afraid rates were going to rise, so I locked in for 30 years. I bought my third house in 2015 and at like 4.5% or something, and I was afraid rates were going to rise, so I locked in for 30 years. My point is that I cannot predict interest rates. I don't think any of us are predicting interest rates, and I keep expecting rates to be rising. I expected them to rise last year. They did not. Rates have been inching up. They have been inching up above 3% for the first time since April, except this week they're back down under 3%. So rates could rise. I keep thinking they're going to. If they do, I think the threshold to pay attention to is if they get to 4%. If they get to 4%, they're going to be back at our long-term average. There's going to be most of the country is going to has rates below 4%. Vast majority of mortgages are below 4% now, and so it could start to feel expensive when rates are above 4%. And that's when I would expect things like inventory to rise, demand is slow. We would be able to see it in a number of these metrics and a couple of the other metrics that I will show you in a few minutes. That's the threshold that I'm looking at, 4%. The question is, I don't know if we get there, or maybe we get there quickly. If we get there between now and say February, like that could put a very big damper on the year. If it happens slowly by next October, maybe it's a slower damper. That's the outside variable here. Assuming those don't change, things are set up for a very strong demand, a tight supply 2022. One of the ways we measure demand, and we've been doing it all year, is through the immediate sales tracker. The phenomenon is also known as like 0 days on market. These are transactions that happen essentially immediately after the home gets listed for sale, maybe within hours or days. Sometimes it's because we've been using a coming soon, and so it's pre-marketed, but there's enough demand that that the homes are buying essentially immediately. What we've noticed, and this has been surprising to me, is that even as supply and transaction volume declines through the end of the year, we have fewer new listings and fewer purchases, but the same percentage of homes are going into contract essentially immediately. So about 25% of the properties are going into contract essentially immediately. This week, it's just under 20,000 of them within hours or days of listing. And so I expected that to be dropping a little bit. It has not. I will be looking. So if the market turns, we will, one of the first places we'll be able to see it is in this immediate sales tracker. Like if buyers are cooled by higher rates, for example, they will be first thing that's going to happen is they're not going to make those first offers. And those, all of a sudden, our immediate sales are going to shrink. We can see a little bit of that change. Like now there's fewer multiple offers, but down to 2 instead of 10 on properties. We can also see it in rising price reductions, which is our next slide here. The percent of homes on the market with price reductions is usually in the 30 to 40% range. It's usually a band. That means 35% of homes, when they get listed, take a price cut before they sell. That's a rule of thumb nationally. In some markets, that's higher than that, especially in the markets that have a lot of investor action, places like Phoenix and Texas. Price reductions tend to be higher. They tend to be lower in like the hot California markets. But in general, think about it as a 35%. When markets are hot, there's more offers than we're expected. And so all of a sudden, only 25% need to take a price cut. Or when markets are cool, all of a sudden it's 40 or 45 or 50%. Half the stock has to take a price cut before they sell. By the way, I noticed some hands going up and things. Use the chat box for questions. We've got Lael and Jeff from the Altos team in the chat, so they will share links and they can answer questions along the way. If you've got questions, we'll take them in there. Okay, so what we're doing right now on price reductions is we're currently at 28%. So you can see the line for this year, the dark red line for this year is definitely fewer reductions than normal. It's higher than last year, but it's starting to tick down. So like this, you can see we had a little peak slightly earlier in September. This is showing to me fall demand a little bit higher than normal, than I would have expected, like increasing maybe even. I was expecting, as we were in the September timeframe, as price reductions were rising, I was seeing maybe we're going to get back into a closer to our normal cycle. I think we will get closer to our normal cycle, but we're going to end. We're still hotter than normal, and this is one of those leading indicators that tells us that the transactions that happened in the first quarter are still going to be priced very strongly, very good. What happens is home is on the market now. It gets an offer in December. It closes in January. If it doesn't get an offer now, it does a price reduction now, and then gets an offer in December and closes in January. And so the more of those doing price reductions now mean the lower prices, transaction prices will be in January. And so that's why this is a leading indicator. If this starts to climb, this will be another early place where we can watch for a market turning. If you have sellers or potential sellers who are thinking of like trying to get a high, like let's see if we can test the market and see what we can show. What we want to do is look in the local market. Look at your Altos report in the local market. Look at the price reductions. If the price reductions is climbing and is higher than normal for your local area, that's going to be a signal to your seller to make sure that they price correctly. If it's falling, if it's in the 20s or in the teens like it was earlier in this year, and I'll show you a couple of those markets, that's going to be a signal to the seller that, okay, let's give it a whirl. There's a big difference in a bunch of markets in terms of that you can see in price reductions that will be important for you to work with your sellers so that they know, because they may still have the impression from several months ago. Let's look at the other side of that coin. This is price increases. So there is a certain percentage of the market who these are properties that were on earlier at a lower price and then now back on at a higher price. Very often these are flips, they're fix and flips, they're off, quick remodel, back on the market. Sometimes it's other investor things. Sometimes this is a marketing strategy. We're just going to take it off the market and put it at a new higher price bracket where there's more demand. So there's always some amount of price increases. Normally it's in the 2% range, 2 to 3%. And you can see there's a normal annual curve. It peaks early in the year. These are homes that are like investors. You buy at the low point and you try to sell at the high demand point. and then it eases down. What's fascinating here, you can see in this chart last year, we had this massive price increase surge because there was a little panic in March and April. And then we started realizing there was, homes got pulled. Then we started realizing a lot of demand. They came back on at higher prices. They even came back on a couple of times at higher prices. And so this year in March, we had this peak where 7.6% of homes on the market were at price, had increased their price. It was a massive, massive surge. Then we corrected down back much closer to normal. But what we're seeing right now is we're at 3.6%. It's climbing the last few weeks, which has surprised me. What that tells me is that we have unseasonal levels of demand, like surprising levels of fourth quarter demand. I think a lot of this is folks who got priced out of the market earlier in the year, and now they finally have a little bit of buying opportunity, and so they're going for it. It's a fascinating thing to keep our eye on at this time. We're going to do just a couple more, and then I'm going to switch over to some local data, and we'll wrap up. Percentage of homes that have been relisted. This is the fascinating number, and it's one of the signals that we want to keep our eye on to know if a market is rapidly cooling. If we get to a situation where there's a spike in rates and buyers are all of a sudden get very cold feet, things will happen like properties get pulled because all of a sudden there's no offers, and then they get relisted again, or a contract falls through and now it gets relisted. And those start to climb in a cooling market. Relisting has been elevated a little bit this year from where it was earlier in the year. At the end of the year, what happens is we're going to pull stuff for the holidays. Lots of stuff gets pulled for the holidays, and then you'll see a January spike. New stuff comes on. This year, the spike was lower because we didn't have to pull things over the holidays. We just kept people just kept buying through this. So there's a lower spike of relistings. What we'll see is one of the leading indicators that we'll keep our eye on will be relist should drop over the holidays. You're not bringing it back on. You take it off the market for Thanksgiving and Christmas time. And then we're going to see how big that spike is in January. If that spike is big in January, that's because the market was cooler than we expected. And people were not getting the offers they wanted. And that's going to be a bearish signal for the first quarter and for the year as a whole. My guess is it's actually not going to be a very big spike because transactions are happening quickly still. Prices are staying elevated. So, but it's one for us to keep our eye on because we always want to be in this ahead of any changing market. We'll switch to a couple of demand metrics right now. 42 days on market median around the country. Days on market's climbing as it normally does this time of year. Last year, as things were crazy late into the year, days on market did not start climbing until in December. But you can see most of these years, it's ratcheting up every week as we go later in the season. Then in the first quarter, new inventory comes on, transactions happen faster, it falls again. We're starting lower, transactions are still happening faster, they're ticking up, but this tells us that our demand is staying elevated later in the year. Just another thing to keep our eye on for demand metrics. And then the Altos, we have this unique indicator that is called the Market Action Index. It's in every Altos report. It works like a little speedometer. And when it's higher, that is tighter inventory relative to the demand levels. If demand starts to slow or inventory starts to build, this number is going to tick down. 30 on the scale is balance, is a balanced market. Below 30 is buyer's conditions. Much below 30 is when you're going to start seeing prices correct down above 30, seller's conditions significantly above 30 means it's really strong seller's conditions. We've been in seller's market conditions for several years. Inventory's been tight and tightening for a decade. And so we really haven't seen buyers opportunity conditions for almost a decade nationally. And so what I want to point out here is the curve from this year. You can see we peaked in June, right? May, June was a peak of the frenzy. Things backed off significantly. But in the last few weeks, we've got a little bit of a rise. That's because fall inventory is declining as it normally does, fewer listings, but the demand is still there. It's been fascinating to watch this tick up for several weeks in a row. And we'll see how that sets up. But again, it's just another one of these bullish indicators that sets up 2022 already for a strong year. So, as we look, we're looking at 2022. All the leading indicators show tight inventory, strong demand. And the risks are things like rates rising and recession or inflation or other economic challenges. And they're looming. They're not in the data yet, but they're looming there. And so we want to keep watching the data to see if and when they do, in fact, hit. At Altos, we like to watch every market in price range segments, 4 price range quartiles. The high end of the market may be behaving very differently from the low end of the market. And these are our national quartiles, our national market segments. You can see the low end is about 150,000. The high end is around 1 million. And this is 25% of the homes. And then there's a sweet spot at about $300,000 to $400,000, where the greatest volume of transactions happens. This is where the buy box is for a lot of those big investors, the institutional investors. This is the sweet spot of demand, and it's about $300,000. And you can see it in demand because we look at the days on market over here, the column on the right. You can see if it's $1 million home, it's taking 56 days. The lowest days on market is over here at in the $300,000 range, and that is only 28 days. So everything is still faster than normal. Just you can absolutely see where the demand is in the market. When you look at your local market, one of the reasons we like to do these segments is that because local markets are so different, nationally, $1 million is the high end of the market, but in a lot of like the coastal markets, the expensive coastal market, like a lot of California, $1 million is the low end. And so what is in San Jose, what happens to the low end, the $1 million properties, where the versus the high end being $3 million properties? What happens to my friend Larry in this case when he's buying a $2.5 million property in LA, and maybe he's not even at the top end of his market? So these are why we want to use this. Especially when our buyers or sellers have an opinion, they're coming to the market with an opinion already. We like to say, okay, in your price range, you're shopping in this $300,000 price range. So, you're in the fastest transaction spot. If you want to get this house, we need to make an offer. I think I've told this story before, but I had a contractor who was working on my kitchen, and he asked me, he said, "Mike, is my realtor lying to me? My realtor says I have to make an offer today, and I'm afraid." And I said, "Let's look at the number," and we can look. And he was buying in San Jose, and he's a contractor, and he's a reasonably successful guy, but not that successful. He's still buying $1 million house, and he's nervous about it. And we looked, and in his price range quartile was the second quartile there, the second from the bottom, and it was 7 days on market. And I could tell him, your realtor's not lying to you. Like, these things are going in 7 days. And so ultimately he texted me, later that day and said, okay, Mike, I'm making an offer. And it was because all these uncertainty, we talked about like there's more uncertainty now than there ever has been. And so the data is what we're using to help them make the right decisions. By the way, I go through a lot of the data. I go through a lot of the conversation. If you're trying to understand how to communicate the data, we've written an ebook, and if you haven't already gotten the Altos ebook, you should go get it right now. It's how to use the market data in your real estate business. It talks about the data, how you can look at it in your local markets, some scripts to be able to communicate with your buyers and sellers. There's a link to download that in the chat. So if you're trying to think about it, this is your opportunity to go do that. And while you're there, you can also book time with our team to look at your local data. Let's look at some local data. I'm going to switch over there right now. There's a few markets that have been kind of interesting that I want to keep my eye on. Boise was one of the super hot markets earlier in the year. We talked about the Market Action Index, still in a super strong seller's market, but ticking down in the last few months. And the stat that is most inventory for me in Boise is the percentage of homes with price reductions. We're at 47% of homes with price reductions in Boise right now. If I look at that over time on the Altos report here, we can see that normally we're in this 40% range. It's not uncommon to be in this 40% range. Earlier in the year, the price reductions in Boise were under 5%. That means a third of homes think they're overpriced, but only 5% have to cut their price before they sell. It was so crazy hot. What we've noticed is that now there are a lot of people who thought they were getting that. They entered the market late in the summer, and that demand has cooled way off. And so all of a sudden we're in the 40s for price reductions. There's still a tight inventory, and we can see tight inventory here. If we look at the inventory chart, we're still fewer homes than we were last year at this time. And if we extend the chart out further in history, we could see that it's even higher normally. And so higher but ticking down now for the fall. So not continuing to increase, right? Normally in our normal fall time. Here's our last year. Here's this year. Here's 2 years ago in a much more normal time. So inventory has risen into much more close to normal, but not crazy high. And so, but what this is telling us is that you can see that sensitivity, and you can really see it at the high end of the market. The $1 million homes in Boise taking now 42 days, where anything under $500,000 is going in 3 weeks, still going super, super quick. That was an interesting view in Boise. Austin is another one of the ones that's been insanely hot this year. Here's price reductions in Austin is now 40%. Similar thing. A lot of the California buyers coming in and making as many offers as possible. Here's our price decreases over time. And, so Austin is one of those markets. Texas in general has higher price reductions. They're usually in the 40s, where California is often in the 20s. But then you can see Austin this year. Last year was 30, and now 7%, 6% is where at the peak of the frenzy. We're now cooled back into much more normal state, but still actually hotter than normal, right? So instead of 50%, we're at 40, and you can see that. If you have a seller who thinks they want to test the market and they think that it's 7%, they think we're back here, like this is really important data to share with them before they sell. And then let's do a couple more. Las Vegas is one that I like to keep my eye on, especially when we're in a potential transition time. Vegas is a high volatility market, so high on the upside in the boom times and crashes hard on the crash times. And so we want to keep an eye on, for example, inventory and price reduction. So inventory in Vegas, way down, even from last year. We had a lot up, but as of right now, the demand in Vegas, a lot of inbound immigration, it's a very affordable city. Like those trends have not turned the corner yet. And so Vegas continues to look reasonably strong. Fascinating that it's still stronger than the Boise or Austin phenomenon. So that's encouraging, but it's also one that we'll like to keep our eye on. I've heard talk that some of the low-priced markets may be where we should look for forbearance properties coming. I didn't do an exhaustive search, but I'm looking at, for example, Kalamazoo, Michigan. Median home price in Kalamazoo is just over $200,000. We can see price decreases in the 40%. And here's what we've got for inventory. So we have the inventory trend, from 400, 300 last year is down to 150. We had some rising. We haven't seen any increase in Kalamazoo inventory this week or the last few weeks. It's a little bit up from the lows. But so a little more normal than last year, but really no indication there of significant coming out of forbearance, for example. And you can interestingly see, in Kalamazoo, in the price range of market segments, just under 200,000 here is faster, and anything over 600,000 this is bigger properties. The low end are more urban lots, older urban lots, but it takes significantly longer to sell those higher end properties in Kalamazoo. And I'm going to do one quick check in the Southeast. I've got Alpharetta, Georgia open up. Here's an interesting thing in Georgia. The Market Action Index has actually been increasing this fall. So that shows a different demand change than the West Coast markets, or Austin or Boise, where we saw inventory climbing and the Market Action Index ticking down just a little bit. So in Alpharetta, you can see the Market Action Index is off its massive peak earlier in the year, but starting to tick up this, in the fall. If we look at our price decreases, we can see normally lots of inventory and, in this 40-50% range. Last year in 30s. Our low here was about 10, but we're still under 30. So it's interesting to watch Alpharetta, suburban Atlanta, hold its very, very hot, stronger than Austin or, for example, Boise or even Vegas this year. Okay, that is the time we have with the data today. I get to this point in the conversation, and there's often people who say, "Hey, can we look at my local market? Can we look at this place? Can we look at LA?" I don't have a chance to go into all of it. So the answer is yes, we can look at your local markets. Go to altosresearch.com and book time with our team, and we will go look at your local markets, and we'll see, what are the trends happening? What are the best things, the scripts to use with your buyers and sellers right now? How can we help people make decisions? Like, is it a good time to hedge against coming inflation? Is it a good time to wait and hold on to cash and try to see if there are going to be bargains happening? Those kinds of conversations are what your buyers and sellers are happening right now. There's so many conflicting views in the economic data that the next year is going to be another year of big uncertainty, and that's what the data is for. So thank you for your time today. Go to altosresearch.com. And this, there will be a recording of this available in the Altos Research YouTube channel, and all the attendees will get an email later today that has the recording. So watch your email, go to the YouTube channel to subscribe there to get to get this and all our weekly videos. And there's a link for the download for the YouTube channel, for the ebook, for all those things. You can go grab those in the chat right now, and I will look forward to talking with you all again soon. We'll stick around. There's some folks in the chat. If you have questions, feel free to ask any more questions there, and we'll take it from